On April 13th, 2025, one of the most shocking events in the crypto space unfolded. The token behind the Mantra protocol, lost over 90% of its value in just a few hours. Just days earlier, OM was trading around $9, pumped by hype around real-world asset tokenization and DeFi integrations. But within hours, it fell to below 50 cents, erasing hundreds of millions in market value, crushing investor confidence, and raising serious concerns. So what exactly went wrong? According to Mantra's co-founder John Patrick Mullen, the primary cause was a series of forced liquidations on centralized exchanges. OM's price began to fall, and that triggered margin calls and auto liquidations. Because OM's liquidity was relatively shallow, even small sell orders created massive slippage, accelerating the crash. But that explanation didn't satisfy everyone. Blockchain analysts quickly noticed something disturbing. Just before the crash, 17 wallets sent a combined total of over $227 million worth of OM tokens to exchanges. These weren't random users. Many suspected they were internal or linked to early investors. While the Mantra team denied any insider dumping, the timing raised eyebrows. It looked like a coordinated move to exit before a known price collapse, a classic rug pull pattern in a more sophisticated form. The community was outraged. OM holders, many of whom were retail investors, were blindsided. Telegram groups exploded with accusations. Binance issued a brief statement explaining the liquidity issues, but confidence was already broken. In response, Mantra's leadership announced urgent recovery measures. They burned 300 million OM tokens, about 1/3 of the circulating supply, and even slashed the founder's own allocation by 150 million. The move was meant to show commitment to the community and stabilize the tokenomics. But trust, once broken in crypto, is hard to regain. The crash highlighted several critical vulnerabilities, not just in the OM project, but across the DeFi space. Let's talk about what you can learn from this. First, always research token distribution. If a small number of wallets hold most of the supply, that's a major risk. A sudden sell-off by a few insiders can completely collapse the price. Second, track on-chain wallet activity. Tools like Etherscan, Arkham, and DEX tools can show you when large holders are transferring tokens to exchanges. If you see movement before a big event or price shift, be cautious. Third, check liquidity depth. Low liquidity tokens, even if they have high market cap, can crash fast if large positions are sold off. Ask yourself, can this token absorb a few $1 million in volume without crashing? Fourth, understand centralized exchange mechanics. Many tokens are listed with minimal market-making support. If margin trading is enabled, cascading liquidations can turn a small dip into a death spiral. And finally, diversify. Don't go all in on any single token, especially in speculative markets. No matter how strong a narrative seems, anything can go wrong. From smart contract risks to insider moves. The OM token crash will likely be studied for months. Whether it was poor risk management, insider selling, or a liquidity trap, it was a painful reminder that crypto remains a high-risk space. But that's why we're here. At ChainWatchtower, we break down real events like this to help you learn, stay alert, and protect your portfolio. If you found this breakdown helpful, hit subscribe. New videos weekly, covering scam alerts, token risk profiles, and honest crypto education. Stay safe, stay informed. Web3 rewards the cautious, not financial advice.